bullish on NextEra Energy. This is the NEE Stock analysis. Hello, everybody. This is StockerFinance. I'm your host, David Scheuer. Make sure to follow me on Twitter at StockerFinance for more information. So first off, what is NextEra Energy? Well, it's an energy utilities company. It's actually the largest electric utility company by market cap. It's the world's largest generator of energy from both wind and solar. It has a bunch of subsidiaries. So this includes the Florida Power and Light Company, NextEra Energy Resources, NextEra Energy Partners, Gulf Power Company, and NextEra Energy Services. And we'll talk about those in a little bit here. On top of that, NextEra owns nuclear energy plants, oil and gas, etc. Also, Florida Power and Light is the largest subsidiary out of all those subsidiaries, and it'll play an important part here because it's also one of the fastest growing subsidiaries, as performing very well in Florida currently. So if we look at the 5-year chart here, we have an average return of about 35%, just very, very steady growth here when it comes to the stock price and the market cap of this company. Its market cap is around $140 billion with a pretty high PE ratio of just 40. So, or just about 40. Now, for a lot of you, you may say that doesn't seem like super high PE ratio because most of you probably invest in lots of tech companies. I'm just saying that because I make a lot of videos on this channel about channels that have extremely high PE ratios, such as, Tesla, for example. And for a utility company, a PE ratio of 40 is actually pretty high. And the dividend yield, it actually has a decent dividend and a fast growing one at 1.96% right now. We'll talk about that more as well. If we keep moving on here, during the market crash back in March, it dropped about 35%, but it recovered about 60% since then. On top of this, it's actually doing a 4-for-1 split, which is extremely interesting for me. It expects that to happen on October 27th. So if the 4-to-1 split happens, which it definitely will most likely, it'll be around $35 a share using the current price. But if the price keeps growing, then that per share price it'll increase, obviously. Now, a stock split doesn't actually mean anything necessarily, but it can give the stock price a boost simply from increased demand. More people can afford the stock. It's a little different now that there's fractional shares and there's a lot more technology available that doesn't make a stock split as important, but there's a lot of psychology behind it that kind of goes into a stock split, and that's why they really do it. But it doesn't change the market cap. Your shares aren't necessarily, the shares, if you own any shares of NEE, it's not going to be worth less necessarily at all. Most likely the shares will actually increase from increased demand, as we saw with the Tesla stock split. Now, if we continue on here, it's also pouring billions of dollars into battery storage capacity, which is probably the component of this company that I'm most interested in. I follow a lot of wind and solar companies, a lot of energy utility companies as well, or that deal with renewable energy. And this battery storage sector of this company and how much they're investing into it is super interesting. I mean, they're investing billions of dollars to build battery storage, across the country, and especially in California, which has seen a lot of rolling blackouts recently. And the company has a sizable pipeline of projects under construction and in development, and it'll significantly bolster the company's ability to store power. This will enable the wind and solar energy facilities they support to generate the near-firm electricity required to meet baseload demand. So the fact they're increasing this battery storage is something that definitely intrigues me as we move on through this analysis. Now let's dive into some numbers and some fundamentals here and just the financials of this company to see how it is at its core. And what the first thing I wanted to look at here is simply its earnings per share. And we see nice earnings per share growth over time here, generally beats estimates, as we see by this little basic chart here, but nothing too exciting to look at there. If we go on to look at its revenue, we see nice growth as well. From 2013, it's doing about 15 billion. Now we're looking at about 19 billion. So this isn't a tech company, not super fast growth. We're not looking at 100% growth year over year or anything like that. Just very slow and steady growth in terms of revenue. We see that very similarly when it comes to gross profit. It does change, however, when we go down to net income. That's why I highlighted it in orange and not green. It's not a bad thing necessarily. It's just not as steady of growth. It's a lot more volatile year over year than it is with revenue. So we see, it was 1,900,000,000 back in 2013. 2014 is about 2,400,000,000. Then we moved to 2018 is about 6,600,000,000, and now it dropped down to 3,700,000,000. So just about. I'm kind of rounding the numbers here, as you can see. So anyways, that's not necessarily super concerning as long as it keeps the growth going. Maybe, at least every 2 years. We don't want to see multiple years of a drop in growth, because that could definitely signify that something is going wrong with the company, their margins are out of whack, or something strange is going on. We kind of see a similar thing with their basic earnings per share here. However, we still see somewhat steady growth over year. I'm guessing most of it just has to do with the current situation at hand, but this is 2019 that we're looking at, not 2020. So perhaps they spent a bunch of money that year on a big project. Who knows exactly what happened? I could look into it in more detail. Maybe I'll send out a tweet if I find out the answer to this question about why the net income and its earnings per second are a little volatile. Definitely more volatile though when it comes to net income there, which is interesting. Now, if we go ahead and look at the revenue on a quarterly basis, not a yearly basis like we were looking at before, we can see further growth as well. A little more volatile. That's kind of what you expect, especially with the current situation that we're dealing with now. I'm not surprised revenue dropped this quarter at all. We also see that with net income, which has continued to increase over time, but has definitely been a lot more volatile and not as steady this past year. Or in 2020, going from 400,000 to 400 million to 1.2 billion. But that's great that they're making more money than they did last quarter, especially when March 31st. That's basically exactly when the whole situation occurred. And over time, it did really badly. But the fact that they increased their net income quarter over quarter showed that this whole situation hasn't necessarily negatively affected them in too harsh of a way. And we see that with their basic earnings per second as well, or earnings per share as well. And if we go ahead and look at cash flow, it becomes a little more interesting as well, with cash flow being very volatile. And if we look at this cash flow chart here, or this isn't cash flow, that's a net income there. If we look at the net income chart here, you can see shareholders' equity increasing pretty steadily. You can see net income increasing steadily as well, but a little more volatile and not as fast, or not as what we're used to seeing with a lot of these tech companies or a lot of these fast growing companies that tend to be in the headlines these days. It's much more steady and slow growth. But as a growth investor and someone who wants this kind of safe, diversified company, it's definitely an interesting stock to take a look at, especially when you look at its shareholders' equity increasing very steadily and a lot quicker than its net income there, in terms of percentage basis at least. One concerning thing though is its return on equity. Now, return on equity, what this is, it's a measure of the profitability of the business in relation to the equity. Because shareholders' equity can be calculated by taking all assets and subtracting all liabilities, return on equity can also be thought of as a return on assets minus liabilities. Generally, a good return on equity is between 10 and 20%. Now, everyone kind of has their own target return on equity, what you want to look for in a company, but let me tell you that 8% is not the best return on equity. As you can tell, it's been significantly better in the past, but something happened there in 2018, whether they started spending a lot more money, taking on a lot more debt, causing their shareholders' equity to decrease, but that wasn't the case here. So I'm not really sure what happened. We see shareholders' equity increasing, net income increasing on a steady basis, but its return on equity decreased pretty substantially there. And that's not necessarily the greatest thing you want to see, but it's not something that I would substantially worry about with this company. It's not a huge red alert yet. It's just not like the best return on equity you're going to get out there when it's, especially when it's below 10%. Now, let's go ahead and look at its assets, its liabilities as well. We see cash on hand being very volatile. And if you look at cash on hand, it's really all over the place. And I was trying to wrap my head around this, because usually when a company, it saves up money in its bank account, basically, to make a really simple analysis of it. And as it saves money, this cash on hand grows and grows and grows over time as it kind of just saves this pile of money, invests it, etc. But cash on hand for this company is really all over the place. We see it spike up to about 3.6 billion randomly, and then all the way down to 1 billion. And I think that has to do with the fact that this company spends a ton of money and takes on a lot of debt for these huge, basically infrastructure projects. For example, the battery storage project they're working on, or, nuclear energy plants, wind farms, solar farms, stuff that requires a lot of financing, big down payments, things like that I could easily see cash on hand
becoming very volatile when it comes with these large projects, especially if there's a random thing that comes up. Oh, we got to make this huge payment now or this quarter, and then next quarter, oh, there's no payments this quarter, or we're not taking on as many big projects this quarter, so we're gonna have a lot more cash on hand. I could definitely see it being very volatile when it comes to that. And you can see year-over-year quarter growth, it's kind of all over the place as well. Definitely no steady chart to look at here, but it's nothing too concerning to worry about, especially when it comes to this utility company that is taking on so many big projects. It's honestly what I would expect with this company, at least as of right now. Perhaps when they get more of the infrastructure projects built, more steady, we could see more steady growth in the future. But it's such an old company that I'm not really sure that'll ever happen. I think it's always going to be continually building more big projects, building more wind farms, solar farms, getting into new areas, acquiring new companies, etc. Cash on hand will always be a little out of whack for this company. If you look at total assets there, it increases very steadily as well. Same with total liabilities, but not as quickly. We're seeing shareholder equity increase as we saw before. Current assets increasing to 7.58 billion. Now you may say, okay, this is a little concerning. Current liabilities are greater than current assets. Most of the companies I analyze, I always look for companies that have current assets or total assets or current assets greater than current liabilities, because I want that ratio, the current ratio, to be at least above 1. The last video I did, I usually look for a current ratio at about 1.5. And in the last video, I think on Disney's ratio is at like 1.8 or something like that. I think I'm pretty sure it's close to that. And that's a ratio that I'm a lot more comfortable with as an investor. But this company, again, takes on a lot of debt. It deals with a lot of different situations, financing. If you looked at this quarterly report for this company as a whole section just about its credit rating, just about how it's a company that takes on debt, how it actually takes on less debt than other companies that we'll see or than its competitors. It's saying its debt takes on about 40% compared to its capitalization, or its companies take on significantly more. We'll look at that chart in a second here. So this is something that I was a little worried about, but for a utility company like this that's dealing with a lot of debt, a lot of moving money around in different places, similar to how its cash on hand was really out of whack, its current ratio is not something that I am too afraid of. As long as its current assets continue to grow steadily over time, we'll see liabilities grow with that as the company takes on bigger and bigger projects and continues to expand and steadily grow over time. It's just nothing that I'm too worried about right now, but definitely something to just pay attention to. And this is the thing that I was talking about with this is adjusted debt as a percentage of total capitalization. I mentioned it briefly a second ago. And you see that NEE is at 42%. And it didn't give us the names of any of the other companies or anything like that. So I could do the research and figure out if this is entirely accurate, but I'm going to trust them on this. And it's saying that it's lowest among its key peers on an adjusted basis. Now, key peers, they probably could have just picked anyone for this graph, so definitely take this chart with a grain of salt here. But this is a good chart and it's a good highlight to pay attention to. And the next few slides are going to be a lot of highlights from their most recent quarterly earnings report. So here's the energy highlights. So NEE grew adjusted EPS by 11% year over year. It announced plans to retire its last remaining coal unit, which is the Florida Light Company's last remaining coal unit, which has a moral investor, someone who invests morally. That's a really good sign for this company. I don't really like investing in a company that deals with coal or something that's polluting the environment. So I appreciate that a lot. On top of this, had a successful quarter of origination at Energy Resources. They added 1,730 megawatts to the renewables backlog, which now is a total of 1,400 and 400 megawatts, which is a pretty massive backlog. It's the largest construction program in their history, remains on track, which is great to see as well. On top of this, we see net income and earnings per second for the Florida Power and Light results increase year over year, which is awesome. And this company right here is really interesting. I think it's one of their best subsidiaries that they own. It's their largest subsidiary, and it's one that I think is going to do very well into the future for multiple reasons that we'll get into here. On top of that, as I said, they added 1,730 megawatts added to their backlog, which is 708 megawatts of wind, 844 megawatts of solar, 178 megawatts of battery storage, executed build, own, transfer agreement for a 200 megawatt solar project, which is not yet included in the backlog. So if you were to include that, you'd actually be at 1,930 megawatts added to the backlog there. On top of that, they had 1,400 and 400 megawatts renewables backlog, which apparently, which I mentioned a second ago, which apparently is larger than the operating wind and solar portfolios of all but 2 other companies in the world. So they're really keeping up with competitors and staying on top of the game with this massive backlog of energy there. Now, if we go through here and look at some of the earnings per second with all their companies and all their subsidiaries here, we see the Gulf Power increase from 9 cents to 11 cents. In terms of their GAAP earnings per second, and we see the Florida Light Company go from $1.37 to $1.52 with a 15 cents change and a 15 cents change unadjusted as well. We also see Total increasing from $2.56 to $2.59 and adjusted $2.35 to $2.61. Excellent growth there. Now, the reason I was talking about that Florida company, the Florida Light Company, is because the population of Florida is steadily increasing. It's actually picked up in recent years pretty rapidly. With that increase in population and the fact that Florida was really, this whole situation, it stayed open for a lot of it. It's been pretty active, although they've had to deal with a lot of shutdowns randomly, lockdowns then and there. The utility companies as a whole, I don't think were as affected as in other places. And I think because more people are staying in as well, they're using more power in their homes, more energy because they're staying in. They're not, having to leave all the lights on, do the dishes more, whatever it may be, taking more showers. Who knows what it is? I think they're going to benefit greatly from this consumption of energy in Florida. And as the population increases, that means more people need utilities. There's more homes built. That means there's more commercial properties going up that need energy, etc. More businesses being started, whatever it may be. And I think this company, the subsidiary, will benefit greatly from that. And I think it's going to continue to grow and be a really important part of this company. Now let's move on to some important news here. So their CEO recently, and this is a Motley Fool article that I'm referencing here, he noted that despite the challenges created by the COVID pandemic, all of our businesses continue to perform well and maintain their excellent prospects for growth going forward. In other words, he sees no reason to expect the good news to end, which is great to see. Obviously, it's created a lot of a big situation, especially in Florida, a lot of controversies then and there. And the fact that the CEO just said, all of our businesses continue to perform well, maintain their excellent prospects for growth going forward. That's exactly what you want to hear as an investor. Now, the other side of the business doesn't, I'm just going to read this off because it's a really interesting article that I read about its energy and about its growth as well in one of its sectors. So the other side of the business doesn't face the same level of government control, but it is benefiting from regulatory mandates just the same. NextEra is one of the largest providers of contracted solar and wind power in the world. It is benefiting from increasing demand as regulators and customers require utilities to increase the amount of energy, green energy they use. At this point, NextEra has roughly 14 gigawatts of renewable power construction projects in its backlog, the largest number in its history. So growth here looks set to continue as well. All of this has led to impressive earnings growth and notably in the utility space, robust dividend growth. NextEra has increased its dividend far more than a quarter of a century, with dividend increasing by more than 10% a year over that span. Dividend growth is projected to be at least 10% a year through 2022, which would easily put NextEra at the high end of the utility sector on this metric. Sorry, I was really stumbling my words there. Jeez. And this is a great sign for investors. However, there is one problem, which the stock has done so well and the company's growing so quickly as its market cap nearly exceeds $140 billion now, that the yield for this dividend is less than 2%, as we saw, which is decent, but the average utility yield is around 3.3%. So compared to the average utility company, public utility company's dividend yield, it's significantly worse, nearly half that or less than half of that. And as a dividend investor, if you are a dividend investor, that's something that you don't really want to see, and this might not be the most attractive investment when it comes to creating income. But I'm looking at this as more of a steady growth investment rather than simply a dividend investment, and hopefully that yield will eventually catch up to the company's immense market cap growth. If we continue reading on here about California and its whole situation. Now, California's been dealing with a ton of rolling blackouts, and I've always been interested, there's got to be companies trying to take advantage of the situation, especially with the solar technology, battery technology that we've been dealing with. Originally, I thought Tesla was going to come in and, kind of do what they did in Australia with big battery projects there, big solar projects going down. I thought more people would want solar roofs and solar energy, but NextEra Energy is also stepping in, or it might be one of the sole one stepping in here and then doing huge investments into battery projects in California, which I think it will benefit from immensely in the future. And I'm actually really excited that this company is doing it. So NextEra Energy recently highlighted its efforts to prevent California from going dark in the future. The company noted that its contracts in place to invest nearly $800 million to build 700 megawatts of battery storage projects in the state by the end of 2022. To put the backlog size into perspective, the entire country currently only has 1.35 gigawatts of battery storage capacity. Thus, these projects alone will boost the country's capacity by more than 50%. So they're going to boost the entire country's capacity by more than 50% with this project. That's pretty crazy and awesome at the same time. And the fact that they're doing it in California as well is something that I think, with the rolling blackouts, will not only give this company a lot of cred, will get its name out there more to investors, and will also benefit it greatly from a PR perspective and from a profitability perspective, perhaps in the future. So NextEra plans to co-locate these battery storage assets at 6 of its existing solar projects in the state. That'll enable the company to provide California with more low-cost, emission-free solar energy during more hours of the day, as well as improved reliability across the regional electric grid, according to their CEO. Their CEO of NextEra's Energy Resources segment. Meanwhile, NextEra has a pipeline of nearly 2 gigawatts of shovel-ready or near shovel-ready battery storage projects in the state that it could build in 2023 and 2024 timeframe. It can move forward with these projects once it has long-term power purchase agreements with utilities and other end users to support their development, as well as all the needed approvals. If the company built all these battery storage projects, it would triple the country's battery storage capacity. So they're really planning to take over the battery storage capacity of this country by adding so much storage, which with more storage, that means they're going to add more plants, they're going to add more wind farms, more solar farms, etc. Those will all generate revenue for this company. And I think it's in a really good spot here, especially with the rolling blackouts, with people probably wanting to get detached from the grid and go on their own. They could add to that, whatever it might be. I think they could do a lot with this whole battery segment. And if they can successfully do these projects here, I would not be surprised if other countries become interested in doing this as well, especially countries that might experience lots of rolling blackouts or just aren't happy with their current utility situation. These could come in, add a ton of storage, build wind farms, create solar farms, etc. for these other countries. If this one is successful, they'll really get their name out there. I mean, they're increasing the country's battery storage by potentially triple, which is pretty incredible. And they're already working on increasing the country's capacity by more than 50%. So that there's pretty incredible, and I'm super pumped to see that. Now here's a little more information about the money and savings around this whole battery storage situation here. So a decade ago, it cost between $71 to $81 per megawatt hour for a 4-hour battery storage adder to cover 25% of a solar or wind facility's capacity. However, thanks to increasing manufacturing capacity and other efficiency gains, it's now down to $8 to $14 per megawatt hour. That number should keep declining over the next few years as the industry builds more manufacturing capacity and benefits from its increased scale. Current projections have it down to around $4 to $9 per megawatt hour by 2022. Combine the increasingly lower costs of battery storage with similar declines in wind and solar costs, and the industry is on track to achieve a real breakthrough over the next 5 years. According to a forecast by NextEra Energy, by around the end of 2024, the cost of near-firm onshore wind should be between $20 to $30 per megawatt hour, while solar will be around $30 to $40 per megawatt hour, a huge decrease from the cost previously a while ago. For perspective, the cost of a new efficient natural gas power plant would be roughly $30 to $40 per megawatt hour, while existing coal and nuclear plants should run in the $35 to $50 per megawatt hour range. Thus, near-firm renewables will be as cheap, if not cheaper, than all other forms of conventional power, and that's even after assuming government subsidies and incentives inspire, which most likely they will continue on in the future, or these subsidies and incentives will increase depending on the political landscape then. So definitely a super interesting company to look at. Here's my summary of an analysis that I did on this company. This company is so big, there's so many different subsidiaries that it's really hard to break it down. I'd honestly have to make multiple videos about this company to do a full analysis. Perhaps I'll do a written report in the future that can go into even more detail, just because there's so many different politics at play, so much technology going on, different information with solar, wind, battery storage. It goes all the way to nuclear energy as well. They're operating, with tons of very large companies under their umbrella. So there's a lot going on here with this company, and I couldn't even put all of it in this analysis, but I hope this was a great summary for you of this company. I think it's going to be an excellent growth stock and definitely one to keep your eye on in the future and as time goes on. So here's my summary of it. In green, I highlighted the good things. In red, I highlighted the potential negatives of this company. It's growing strong and steady. The Florida Power and Light subsidiary are going to continue to perform well in the future, most likely. It's kind of a negative thing here is it's not undervalued per se. It has a PE ratio of 40, which in the utility sector is pretty high. Its current ratio is also less than 1, which is not the best thing in the world, but I don't think that's something super important to worry about at right now. If it continues to decrease and gets kind of in a worrying era, then you might want to worry about the debt that this company is accruing, but right now it's not something that we need to worry about. Slow growth, it's not going to be a tech sector 10 bagger here by any means. It's definitely more likely a 20% a year company. It did 35% a year over the past 5 years. If it continues on that path, that's a very, very good return, especially for a utility company. So we'll see what happens there. A growing dividend but shrinking dividend yield, so kind of a good thing and a negative to that statement. Huge potential with California battery storage and renewable energy, as I talked about. A stock split coming up 4-1, which will be huge on October 26th, I believe I said. A diversified company. There's tons of different subsidiaries to this company. Although it's an energy company, it's not all in on solar, all in on wind. It's split amongst tons of different things from wind, solar, nuclear energy. It was also in natural gas as well, which I'm not the biggest fan of, but at least it was pulling out of its and shutting down its coal plant in Florida, which is a great thing as well. So definitely helping a little bit with the transition to sustainable energy, and that battery storage project that it has going to potentially triple our country's capacity would definitely help with the transition to sustainable energy, which I really like to see. So anyone, thanks for watching. Please subscribe, make sure to check out these videos, and follow me on Twitter at StockerFinance. I know this video went on for a while. I'll try to keep the next one a little more shorter and condensed, and I won't drink as much coffee before the video so I'm not stuttering during it. Anyways, thanks for watching, and I'll see you guys in the next video. Peace out.